All right, hello everyone, and welcome to a little bit of an extra video. I just had an email come in before of a student, I assume it was a student, could have been a teacher, asking if I could do a video talking about monetary policy type questions, some past exam questions for monetary policy and SAC style questions, and how to go about responding to them. So what I've done is thrown together three VCAR multiple choice questions just to kind of show that they're all incredibly similar in how they're asked, which is probably a good thing for you guys. And then I've got three SAC style questions from the monetary policy SAC that I did this year with my students. And we'll go through where the marks are allocated for those, why I asked those questions and why I think they're important, and look at some sample answers about how to structure answers for those. So we'll start off with some general tips. So with any monetary policy type questions, they boil down to one of two factors which affect impact, or they impact consumers or businesses. So whenever you get any monetary policy type question, if you're asked about expansionary or contractionary stances, how it affects aggregate demand, you can go with either talking about consumers or businesses, unless obviously if it's a very big mark question, you might talk about both. But for consumers, the most common impacts are to their disposable or discretionary income, which then impacts their willingness to save or their private consumption spending and therefore aggregate demand. So when we talk about the monetary policy, the expansionary policy from March, we often talk about the fact that that incentivizes consumers to borrow money, and it de-incentivizes them from saving because there's not as much of a return on savings. So therefore they're more likely to borrow money, which increases their overall ability to spend and should hopefully increase private consumption spending and therefore aggregate demand. We know that's not the case because of low consumer confidence, and we'll get into that later too about the effectiveness of monetary policy, but that's the general idea. Whereas for businesses, it impacts their cost of production via the cost of their business loans that they probably have, but then it impacts their overall willingness to conduct private investment spending. Because if there are low interest rates, businesses are more likely to want to invest and expand, and therefore that increases private investment and increases aggregate demand. Or if interest rates increase or get higher, they will reduce their private investment spending, and then that reduces aggregate demand overall. And so they're the two main ways that it's overall impacted, and the key ways overall. If we talked about the exchange rate channel later with transmission mechanisms, that's a little bit different. And that's more just about how interest rates affect the overall value of the dollar. These are the most specific and the most common routes you'll take. And then from the impact on aggregate demand, you can link that to any of the three domestic macroeconomic goals and how they will or will not be achieved because of that. So we're going to go into some multiple choice to start with. So first up, we've got a question 12 from 2019. A contractionary monetary policy by the Reserve Bank of Australia could be achieved by, and you got your four options: selling Commonwealth government securities to increase cash in the overnight money market, buying Commonwealth government securities to increase cash in the overnight money market, selling Commonwealth government securities to decrease the cash in the overnight money market, or D, buying Commonwealth government securities to decrease the cash in the overnight money market. So obviously there are two key things you need to know here. That with the contractionary stance, if they buy or sell Commonwealth government securities, and what that does in the overall overnight money market. And they ask a similar question to this. You'll see it in the next two questions almost every year. I think part of the reason they do it, like normally it gets between 60 and 70% of people getting the answer correct. And it's one of those things that should be relatively simple, but when your brain is in SAC mode or exam mode, you can very easily trip yourself up. Like I know I still get these wrong sometimes because I just try and do it too quickly and I get one of the directions wrong. So contractionary stance, they are trying to increase interest rates. So already with that, the way I immediately go to it, well, if they're trying to increase interest rates, they are going to want there to be less money in the overnight money market overall. So they're going to want it to be one of these two options of decreasing cash in the overnight money market. And then from there, because if there's less cash available, that puts upward pressure on the cash rate. From there, if they want to decrease cash in the overnight money market, are they going to buy or sell government securities? Well, they're going to sell government securities because they want financial institutions to buy them off the RBA, which takes money out of the overnight money market and then drives interest rates up. So the answer is going to be C, selling Commonwealth government securities to decrease cash in the overnight money market. Hopefully then by that process of elimination, you can get to the right answer every single time. Then we'll move on to question 12, 2018. So 2018, when the economy is experiencing low rates of growth and low rates of economic unemployment growth, which is a weird way of saying low rates of economic growth and low levels of unemployment growth or employment growth, like more people getting jobs, the RBA is most likely to. So looking at this, thinking of our goals, so you'd already be thinking, well, low rates of inflation, that is then potentially below the goal. Low rates of economic growth. Whenever they use the word low, you're assuming it's below the goal. And weak employment growth, that's going to be bad for full employment. So these are all bad. None of your 3 domestic economic goals are being achieved. So if these are not being achieved, what are you going to want to do? You are going to want to have expansionary policy. So expansionary policy means that you are going to want to decrease the cash rates. It's going to be one of these 2 answers. So we can just go C and A, see you later. We don't even care what you say. Might be some nice words, we don't care. So then from this point, are the RBA going to sell government securities to decrease the cash rate or purchase government securities to decrease the cash rate? So that's when we've got to start thinking about the overnight money market or the short-term money supply. How does the RBA get more money into the short-term money supply? So then that puts downward pressure on interest rates. Well, with that, they're going to purchase government securities because that will lead to there being more money in the short-term money market because they'll buy them off the financial institutions. That money will go into the overnight money market, and then that will decrease the cash rate because there'll be the larger money supply available, which puts downward pressure on interest rates. So it ends up being D. Then the last multiple choice question we're going to look at. So question 14 from 2017, when the Reserve Bank of Australia buys government securities on the overnight money market, the effect will be 2. So we just talked about this a little bit. When they buy government securities, that increases the supply of cash. So already, once again, hopefully by knowing that very quickly, you can rule out 2 answers. So bang, you're gone, and bang, you're gone. It's like we're on Who Wants to Be a Millionaire and we get to rule out half the answers straight away, which is great. So then, if they're increasing the supply of cash, what's going to happen? Well, it's going to decrease the cash rate based on what we talked about just before. So it's going to be C. I think 74% of people got this right. And so it's just similar logic each time. The questions have all been a little bit different. They've kind of had pieces of the same question of each time. But if you understand those connections of how cash rates go up or down, you're not going to get these questions wrong, hopefully. And hopefully this kind of logic behind it makes sense to you. Now we're going to get into some short answer questions that I have made up. So first one we're going to look at, describe the monetary policy stance taken by the RBA in March of 2020 and explain one reason why they took that stance. So you've got 3 marks for this one. 1 mark comes from stating that that stance was expansionary. 1 mark comes from stating that the cash rate was reduced to 0.25. And 1 mark comes from an accurate reason why. And your most accurate reason why tends to be from the limiting the impacts of COVID on the economy, because that's one of the main things they came out and said. They weren't even trying to achieve our domestic economic goals. They were trying to limit the negative impact on them. So if we then move on to looking at a sample answer for this, which was written by one of my students. So during March of 2020, the RBA adopted the expansionary policy stance in light of the global pandemic to cut the cash rate to 0.25. So they've already got 2 of the key marks there because they've said expansionary stance and they've said 0.25, which is really great. And then they kind of go into detail about why that is. And it's even nice that they kind of mentioned the global pandemic there too. As the global pandemic has raised health concerns, this has forced businesses shut down, which has influenced people to be laid off their jobs, which has overall decreased aggregate demand. By the RBA implementing expansionary policy, this aims to increase consumer spending, that should be private consumer spending or private consumption, I would say, and decrease household savings. And as households will have more discretionary income due to paying off less debt overall. Just some key things that, like the main things are those first 2 sentences are really key to why they took that stance. They're trying to limit the overall impacts on the domestic economic goals. They're trying to limit the effects of rising unemployment and decreasing economic growth by keeping the cash rate low, which it's looking like it's going to stay for the next 3-ish years at the very least. They want to kind of keep, it's not even stimulating the economy at the moment, it's just kind of like keeping the economy on life support. Because if the cash rate goes up at all, things will get very bad because businesses won't be able to cope, households won't be able to cope with their debt, etc. Apologies for the coffee break. It's my first day at home full time with my daughter because my wife's gone back to work and I've been up since 4:45 this morning and it's been constant. So next question. Using two transmission mechanisms, explain how changes to interest rates could decrease aggregate demand. So this question's come up a fair bit recently, like similar, like it's always the same using two transmission mechanisms, and then the last kind of impact's different. I went with a very specific one here about decreasing aggregate demand because that's all about contractionary monetary policy. And VCAR is kind of sneaky where they like to ask half of their questions about current events and recent things, and then they like to ask a little bit about the opposite because people put all their eggs into the basket of studying the current economy and then they don't know how to explain the opposite. And that's really, really important to be able to do. So when you break down the marks for this, it's just 2 3-mark questions really that have been thrown together. And so 1 mark comes from describing a transmission mechanism. So your cash flow channel, your asset values channel, your cost of credit channel, your exchange rate channel, all those kind of things. I always highly recommend cash flow, cost of credit, or the exchange rate channel. They are the 3 easiest to talk about to the point where, although we look at the other 2, we don't look at them in too much detail because most of the time VCAR is going to give you the option of which one to talk about unless it's a multiple choice question. Then you get 1 mark from explaining how increased interest rates impact that transmission mechanism, so how they affect the specific components of that transmission mechanism and how that leads to decreased aggregate demand. So it's just 3 steps to get those 3 marks and then do it again for a different transmission mechanism. Moving on to the sample answer for this one. So one transmission mechanism is the cost of credit channel, which is the cost to borrow money. Very, very simple way to describe that. That gets you 1 mark. If the cost of credit increases, it results in consumers becoming less willing to borrow money as they're scared of paying higher interest repayments, so they become more willing to save. This will result in less private investment and less private consumption spending, which decreases aggregate demand. So there you go, that's the 2nd and 3rd mark just there. Very clearly why that happens. It says because they're less willing to borrow money and more willing to save, less private investment, less private consumption spending, less aggregate demand overall. Another transmission mechanism is the cash flow channel, which involves how it affects consumers' cash flow. I don't love that definition overall. I'd say probably involves how it affects a household's disposable or discretionary income to be a little bit more clear and 100% on that one. If interest rates increase, it will heavily impact people who have taken out a loan or mortgage as they are required to spend money on these repayments, therefore decreasing their discretionary income. This leads to a reduction in their private consumption spending, which is the key component of how it affects aggregate demand, and therefore a reduction in aggregate demand. It's just really clear those last kind of little points are the majority of like showing that you can apply what you know about that. And it's really important to be able to talk about the fact that it needs to be clear that you know that this is about interest rates increasing to decrease aggregate demand. And that's where some students went wrong in my class. And then lastly, what we're going to look at, and the hardest question overall, and one that's really, really important, probably still going to be really important this year based on the cuts to Unit 4 overall. Evaluate the effectiveness of the RBA's recent monetary policy stance. So very short, but a very big question. So evaluate always being strengths, weaknesses, and a conclusion. I always like at the start of an evaluate question to kind of give a general kind of view or a summary of what you're talking about. So, and then 1 mark for your conclusion. So how this goes is 1 mark for an accurate description of the recent monetary policy stance, so saying it's expansionary, saying why it's expansionary. 1.5 marks come from 1 strength of monetary policy, which is linked to current events. The link to current events is really important because otherwise you have like a lot of people just use strengths from the theory, but some of them don't actually apply to current events. So some of my students used, for example, monetary policy is really effective at slowing down the economy in a boom. It's like, well, we're in a recession, so that's not current. That's not important right now. So it's not really a relevant strength to talk about, so you can't get marks for that. Whereas talking about the fact that the implementation lag of monetary policy is so short, therefore, when they decreased the cash rate in March, banks were able to pass on some of the rate cut the next day. That's really clear and really linking it into what we're talking about right now. It's like the same when you get into the weaknesses. talking about you can talk about the impact lag, that's pretty relevant. Talking about the fact there's what we were talking about, really low consumer confidence is the easiest one to talk about at the moment, because if consumers and businesses aren't confident, they're not going to borrow money, and therefore it's not going to be effective. And then your conclusion about the effectiveness is going to be talking about the fact of, well, people haven't really been borrowing extra money and it hasn't really been that effective overall. But we'll get into a sample to look at specifically what people have said. So, and I apologize because it's very long. All these 5-mark questions are very long. It's basically a 10-mark question from business or legal, but done in 5 marks in economics. But I feel like it's a little bit more direct. So during March of 2020, the RBA decided to decrease the cash rate to 0.25 in light of events such as the global pandemic, thus taking an expansionary stance. The RBA intended to decrease the cash rate in order to boost the cash flow of businesses and households, in order to stimulate the economy and increase overall aggregate demand. So that first little bit is their summary of what's going on. Great for that 1 mark. By cutting the cash rate, households will pay less on their mortgages or any outstanding accounts, leaving them with more disposable income, which can be spent on discretionary goods, thus increasing private consumption spending and aggregate demand. Businesses will also spend less on paying off any business loans and other outstanding accounts, which can increase investment spending. That should be investment right there, as businesses will have more money to expend on their business operations, thus increasing aggregate demand. However, financial institutions aren't legally obliged to take on the RBA's decision. They are able to set interest rates on their terms to most likely to earn a profit, and since the cash rate hasn't influenced the banks, they haven't been obliged to take on this decision, and banks are still charging households and businesses high rates of interest that don't reflect the current environment, which has decreased the confidence of businesses and households on their debts, thus decreasing aggregate demand. Overall, the RBA's recent monetary policy stance of cutting the cash rate to 0.25 has not been effective to aggregate demand and overall the economy. Although cutting the cash rate can decrease households and businesses' debt and stimulate aggregate demand, financial institutions aren't ordered to follow these decisions, thus upholding the same interest rates even though there have been business lockdowns and loss of jobs. This has made households and businesses less confident in the economy, thus decreasing aggregate demand and not stimulating the overall economy. Just a couple minor things with this answer to make it better overall. One really good thing to do, just to be really specific, is always to try and hopefully your teacher's been talking to you about signposting your answers, so being like 1 advantage or 1 strength. So 1 strength, and then being like have a 1 weakness. Just make it really clear when you're talking about one or the other. So this being about the banks not passing on the cuts, that's a really good one. The strength could be a lot clearer here. I'd really go for the implementation lag for the strength, just because it's really clear that that can have that impact on households' cash flow the next day, and therefore really lead to having that effect of, if people have more cash, they'll hopefully be conducting more private consumption spending and therefore stimulating aggregate demand. And that's essentially it for monetary policy. There are a little bit more tidbits you could go into, like talking about the fact of, I had a couple of questions come in via email the other day about how monetary policy directly affects the value of the Australian dollar, and that's important to know. So one of the things about when we have high interest rates compared to overseas countries, it tends to appreciate the Australian dollar. And why that is because when our interest rates are high, it leads foreign investors to invest money in Australian banks or financial institutions because they're getting a higher return than they would in their own country. To invest in Australian banks, they have to buy Australian dollars off the foreign exchange market, which then decreases the supply of Australian dollars because the demand is so high, which makes it appreciate in value. You see the opposite's true as well. When the cash rate was cut in March, the Australian dollar depreciated as foreign investors took their money out of Australian financial institutions and searched for a better return elsewhere. Other than that, if you have any other questions about monetary policy or anything in economics, don't hesitate to email me or leave a comment below. More than happy to help out the best that I can. Other than that, thank you for spending 20 minutes of your life listening to me talk about monetary policy, which is just a strange, strange world that we live in, that in 2020 this is teaching, and teaching is apparently just to whoever will listen to me bang on about economics. On that, I hope you have a wonderful day, and I really am appreciative to my daughter Eleanor for sleeping through this recording. I'll see you next time. Goodbye.